So evaluating serial acquirers can be tough as their assets producing cash flows will obviously change as they acquire more and more businesses. So I'd love
Yeah.
to know, what is your go-to way of evaluating serial acquirers?
hmm Well, first I think they still have to pass all the tests that any other business I would invest in would pass. And so I have some quirky things, that I look for. We talked about balance sheet strength is something that, my tolerance for that is is a lot lower than other people. My tolerance for leverage is a lot lower than other investors. It doesn't mean that you can't make a lot of money in a more leveraged vehicle. It's just my own preference. And then I've talked about a lot, skin in the game, insider ownership is something that I look for. But again, there's plenty of companies, exceptions to that. So those are kind of filters I put on in general. But then when I'm starting specifically to look at a serial acquirer, there's a lot of little things. So, I don't like the ones that are super aggressive and buying up everything. So, an example is like Storskogen in Sweden when it first came out. They were just, they had bought a ton of companies, I think, over a 3-year period, something like 170 companies. It was a lot. They were very aggressive. They were buying everything, and they weren't particularly disciplined about what they were buying or paying all kinds of prices. And you could just talk to people in Stockholm and they would tell you that. So I like the ones that are much more disciplined, steady. I own Lifco. Lifco is a great example. They have a certain model, a certain kind of business they're looking for, and every year is just kind of steady. And that's what I want, like steady, consistent, disciplined deployment of capital, not too much leverage. I look a lot at incentives. Um, those are some key ones. I think, again, you have to consider the opportunity. So Lifco is a good one where they own businesses across multiple countries. So you have a much bigger addressable market, perhaps, than a serial acquirer that's confined to one industry or one geography. So those are things you have to consider. Um, yeah, I'm sure there's more things that will come up as we speak, but there's some traits that I like.
And so if you were to, let's say someone was looking at Lifco right now and they wanted to figure out if the valuation right now was good, what would be
Mm,
kind of the metrics that you personally would use or you would suggest people use? Because serial acquirers, obviously, you can look at free cash flow, which is fine, but the thing with serial acquirers is that if their free cash flow is zero, it just means they're deploying all their cash. So that's not necessarily a bad thing. So yeah,
that's
I'd
right.
love to know what you think on that.
That's right. We want them to deploy their capital. So you really have to look at some sort of free cash flow metric before acquisitions to kind of get at what they're doing. And then you want them to deploy that. But, you raise a good question there with kind of valuation because, people struggle with that a lot. They'll see something trading at 26 times earnings or 30 times earnings and they'll think that it's expensive. But, when you work out what the return on capital is of that business. And you could just look at something simple. You could look at ROE, and then you could look at how much they're reinvesting every year. So if the ROE is, let's say, 20%, and they're reinvesting 80% of that, paying out 20% in dividends, then you've got, 16% roughly in compounding. And that question for you is then, is that good enough for you as an investor? Is it secure enough? Is it durable enough? Do you feel good enough about it that you're willing to just sit and wait and wait? And there's some sliding scale. You're going to find some that, they're doing 30% and maybe they're paying out, again, 20%. Now you're looking at 24% kind of is your compounding. And and that makes a big difference. So then when you think about it in terms of a decade out, just sort of forecast what, 24% compounded is over a 10-year period of time. It's a big number. And then you put a multiple on that at the end of 10 years and compare it to today and get your IRR, you can see suddenly if you have a company that's going to increase earnings 6, 8 times over the next decade, suddenly whether you pay 30 times earnings or 35 suddenly doesn't seem like, that big of a deal, right? So you have to put it in that kind of perspective. So I always say, it's business first, quality of the business first. Spend a lot of time building that conviction on what it looks like on a 10-year view, having a great deal of confidence in that. And again, that means digging into the economics of it, whether or not that's sustainable. and then you figure out kind of what today's price and what the IRR is. I mean, many of them are still cheap, even at 25 or 30 times earnings, if they're successful in doing that. And so you can always, take a toehold position to start, and then you get chances to add along the way. But I always say too, you learn more when you own something than when you just follow it. When you own it, and then you really start to see, the economics of it, you really start to understand, what makes it go. And so that's one way to get over that hurdle.